Hey tech aficionados, let's talk about what had UiPath ping-ponging all over the stock charts today. First up, UiPath seemed to hit a high note, with better than expected Q2 earnings that initially sent their stock soaring by 10.4%. Kudos to the team for making it rain with a $360.3 million revenue, easily surpassing estimates set at $303.7 million. But hang on a second, because just as everyone was celebrating, reality decided to crash the party. The initial euphoria fizzled as quickly as it appeared. The downtrodden U.S. jobs report signaled a weaker-than-expected economic environment, causing tech stocks in general, including UiPath, to dip. The macroeconomic outlook spooked investors, proving once again that not even stellar earnings can withstand a stormy economy. Suddenly, UiPath saw a reversal of fortunes, declining by 5.3% by mid-morning. Now, let's break down those earnings a bit. UiPath specializes in robotic process automation, essentially using software bots to handle repetitive office tasks. The company's Q2 revenue growth was at 10%, where it made a notable stride in beefing up its subscription services, which rose by 21.7%. But here's the kicker. Despite these positive gains, their GAAP losses ballooned to $103.3 million, up from $77.6 million. And although adjusted earnings per share just about squeezed by analyst estimates, 0.44 against a consensus of 3.3, it wasn't enough to escape some grim analyst sentiments. Analysts are a divided lot on this one. BMO Capital Markets pointed out in their note that UiPath met low expectations, citing challenges from the prior quarter. D.A. Davidson seemed a bit more upbeat, highlighting the company's refocus on customer centricity and raised expectations for full-year adjusted operating income to $170 million. RBC Capital Markets highlighted that despite the somewhat ho-hum Q2 results, the software enterprise showed signs of stabilization, an encouraging sign after previous struggles. JP Morgan's take blended positive and cautious tones, underlining good execution but also restructuring efforts that revealed weaknesses. Keep an eye on that $500 million expansion to their share repurchase program, as it's a move that's often a confidence booster, but didn't seem to pacify jittery investors today. Analysts' consensus remained neutral, with most setting 12-month price targets that suggest a slight upside may still be on the horizon, though skepticism persists given the stock's 44.87% downturn year-to-date. Lastly, UiPath's customer base is evolving. The shift from licenses to subscriptions is real. ARR rose 19% with a decent net retention rate of 115%. So to sum up, UiPath had a day of highs and lows, starting strong with surprisingly good earnings and an optimistic shift towards subscriptions, but quickly taking a dive due to wider economic worries. Stock investors are in a precarious position while analysts deliver mixed, yet cautiously optimistic verdicts. Stay wired to the market waves, and let's see how this script plays out for UiPath in a jittery tech stock climate. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.